on this 6 video series that we have got going on. So today we will be talking in this second video. We will be talking about what are some basic financial statements. I will introduce you to them. So financial statements are essential tools that offer a comprehensive view of a company's financial health, how that company is doing financially. They serve as a medium to communicate financial performance and the position to stakeholders such as investors, management, creditors, and regulators. So these statements are vital for making informed decisions about a company's future. So let's talk about what these statements are. So there are three main financial statements. So they are a statement. First is a statement of financial position, which is also known as balance sheet. It provides a snapshot of the company's assets, liabilities, and equity at a specific point in time. This statement highlights the financial strength and the liquidity of a business. Then we have income statement. It is often referred to as a profit and loss statement. It summarizes the revenue, expenses, and the net income or a loss over a particular period. So this statement indicates whether the company is operating in profits or in loss. So the next main statement is statement of cash flow. This details the changes in cash during a particular recording period. So it classifies the cash flows into operating, investing, and financing activities. So offering insights into how cash is generated and used by an organization. Now let's move on to next slide, which is about the statement of financial position, balance sheet, as I have told you earlier. So the balance sheet is the statement of financial position. It provides a snapshot of a company's financial position at a specific time period. So it reflects the fundamental accounting equation. It is based upon an accounting equation which is assets is equal to liabilities plus owner's equity. So both of these sides remain at balance. That is why it is called balance sheet. Then we have what are the components of these assets. Liabilities are further classified into different types. So assets are basically classified into two types of assets. These are current assets and long-term assets. So current assets are the ones which have the duration of up until 1 year or less than 1 year, and then long-term assets have duration up more than 1 year. And then when we move on to liabilities, so liabilities are also classified into two types: current liabilities and long-term liabilities. So current liabilities are which have duration of less than a year, and long-term are which have duration more than a year. So owner's equity is basically the capital that the shareholder has invested in the business. Shareholders have invested in the business, so it is the money that the business that we put into business. So moving on to the next slide, which is about income statement. So income statement, which is also known as a statement of profit and loss, or profit and loss statement. It focuses on a company's performance over a specified period. It details how the organization generates revenue and incurs expenses, ultimately showing the net profit or loss. So what are the key components of this statement? So there are three main components, which are revenues, expenses, and net income. So revenue, what are revenues? Revenues are the income generated from the primary activities or the operating activities of the business, such as sale of goods or services. It can be goods or it can be services. Then we move on to expenses. So the expenses are basically costs that are incurred during the process of generating these revenues, including operating expenses, that is salaries, rent, utilities, and non-operating expenses are internet and taxes. And then we move on to net income or loss. So what is net income or loss? So it is basically the bottom line that is calculated as revenues minus expenses. So a positive figure means the company is going in profit, and negative one means that it is going in loss. So these are the key components. And so what about the structure of income statement? In income statement, first we get the gross profit, which we get which is calculated by subtracting the cost of goods sold from the net sales that a business has generated, or the revenue. And then we come down to operating income, which is the gross profit minus all the operating expenses of a business during a certain period of time, and then in which that revenue is generated, that gross profit is generated, or you can say that sales were generated. Then we move on to net income. As I have told you earlier, it is the final profit figure that comes after subtracting all the tax, interests, and all of the other expenses. So this is basically the profit of an organization. So let's move on to next slide, which is about the statement of cash flows. So the statement of cash flows tracks the inflow and outflow of cash during a particular reporting period. So operating activities, these cash flows come from basically three types of activities. So first is operating activities, then there is investing activities, and then there is financing activities. So the cash flows related to the core business operations, such as cash received from sales and or paid for expenses, they come under operating activities. Then there are investing activities. They are cash flows from acquiring or selling long-term assets, or some type of dividends that we get from investing in certain stocks or other investments. And then there is financial activities. They are cash flows from transactions with shareholders or creditors, such as issuing certain ordinary shares or bonds, etc. And then we move on to next slide, which will tell us about the relationship between these financial statements. So the balance sheet and the income statement, both are related to each other. And how they are related to each other? They are related that the net income that we get from income statement, it affects the retained earnings on the balance sheet, because the retained earnings are the sum of amount that remains after paying off all the shareholder, and it goes straight into owner's equity, and retained earnings are in owner's equity. And then the income statement and cash flow statement is also related, because the net income is basically the cash inflow, and net loss is there is no flow of cash, but there is outflow of cash in that. So they are also related. And then balance sheet and cash flow statement are also related. So changes in assets, liabilities, and equity on the balance sheet that are reflected on the cash flow statement, which is pretty obvious. Then we move on to next slide. Our next slide is about adequate disclosure in financial reporting. So when we talk about disclosure principle, so there are some principles in accounting, like the historic cost principle, which tells us to record the transaction when they happen, and they do not care about the market value of any asset or liability. And so it refers, adequate disclosure refers to providing all the relevant financial information necessary for stakeholders to make informed decisions. So so it is comprehensive information. So financial statements should include notes explaining the methods that were used, and providing context of significant items, such as contingent liabilities, or major events after the reporting period has begun. And then there should be transparency. They should be honest with the stakeholders. So that is very important. Let's move on to next slide, which is about forms of a business organization. So there are three main forms of a business organization. One is sole proprietorship, in which there is only one individual, and he has invested all the capital, and the liability of this one individual is unlimited. And then we have the partnership. In a partnership, it is owned by two or more people, with the equity is divided among all of these partners, and their liability is also unlimited. And then finally we have corporation. The corporation, in this, the ownership is represented by shares, and there are multiple shareholders, and the liability of these shareholders is dependent on how much share they own. And let's move on to next one. So the next slide will be about ethics and corporate governance. So what are the ethical practices? So ethical practices means upholding honesty and integrity, which ensures that the stakeholders trust in a company, and in a company in a company's financial situation. Then I talked about it in a previous lecture. It was Sarbanes-Oxley Act, which was introduced in the United States, in which all of the CEOs and CFOs have to certify all of their financial reporting with their own hands. Then there should be, in ethics, there should be prevention from manipulation of facts and financial figures. There should be laws, and there are laws against these unethical type of situations. Let's conclude our presentation. So what we have learned is that there are multiple financial statements that are vital tools for assessing a company's health and operational efficiency. They have long-term effects. They show the long-term goals of an organization are being achieved or not. They help in decision making and other activities. So that was it from this chapter. I will see you in the next video.